നമസ്കാരം. ഇന്ന് നമ്മളുടെ ഇൻ്റർവ്യൂ സീരീസ് ആയിട്ടാണ് വന്നേക്കുന്നത്. അപ്പോൾ ഇൻ്റർവ്യൂ സീരീസിൽ ഇന്ന് നമ്മളോടൊപ്പം ഉള്ളത് അജയ് ത്യാഗി സാറാണ്. ഇദ്ദേഹം UTI മ്യൂച്വൽ ഫണ്ടിൻ്റെ ഇക്വിറ്റി മാനേജ് ചെയ്യുന്ന ഇക്വിറ്റി ഫണ്ട് മാനേജേഴ്സിൻ്റെ ഹെഡാണ്. അപ്പോൾ ഇക്വിറ്റി ഹെഡുമായിട്ടുള്ള ഇൻ്റർവ്യൂവിലാണ് നമ്മൾ ഇരിക്കുന്നത്. ഇതിൽ നമ്മുടെ മേജർ ഉദ്ദേശം എന്ന് വെച്ചാൽ സെബിയുടെ കാറ്റഗറി അനുസരിച്ചിട്ട് നമുക്ക് ഒത്തിരി ഡിഫറെൻറ്റ് ടൈപ്സ് ഓഫ് ഇക്വിറ്റി മ്യൂച്വൽ ഫണ്ടുകളുണ്ട്. അപ്പോൾ ഇതിനെല്ലാത്തിനെ കുറിച്ചിട്ട് ഒന്ന് സംസാരിക്കുക. എന്നിട്ട് സാറിൻ്റെ ഒരു അഭിപ്രായത്തിൽ ഇതെല്ലാം എന്താണെന്ന് നമുക്ക് മനസ്സിലാക്കുക. ഇതാണ് മേജർ ഉദ്ദേശം. അതോടൊപ്പം വേറെ എന്തൊക്കെയാണ് ഒരു ഇൻവെസ്റ്റർ എന്നുള്ള രീതിയിൽ മ്യൂച്വൽ ഫണ്ട് ഇക്വിറ്റി സ്കീമുകളിൽ ഇൻവെസ്റ്റ് ചെയ്യുന്ന ടൈമിൽ നമ്മൾ ശ്രദ്ധിക്കേണ്ടതെന്നുള്ളത് ഇദ്ദേഹത്തിൽ നിന്ന് പഠിക്കാമെന്നുള്ളത് നമ്മുടെ ഉദ്ദേശം. സോ സർ, ഐ ജസ്റ്റ് ഗിവ് എ ബ്രീഫ് അബൌട്ട് വാട്ട് യു ആർ ഗോയിങ് ടു ടോക്ക് ടുഡേ, ആൻഡ് now we are moving into English, and we'll take the interview forward from here. And today I'm with Mr. Ajay Tyagi, and he is the head of equity at UTI Mutual Fund, and he is a CFA and done his post-graduation from Delhi University, and in 2000 you have joined in UTI.
Yes.
And I think from there, I think a lot of contribution, lot of help you have done for other people to create their wealth, and I'm the one of the beneficiary out of it. And my father is a mutual fund distributor from long time, and he had a UTI agency, and he got UTI agency when I was in 6th standard. On my birthday, he got the agency. That is one of the sweet memory, and still now I'm continuing my fund which I started investing those days. So thank you for that, and I'm so thrilled to get you in person and talk about entire equity schemes.
My
so welcome,
pleasure,
sir.
Nikhil.
Welcome,
Thanks
sir.
for inviting me. Thanks for inviting UTI for this session. I've heard a lot about your presence on Facebook and the efforts that you are making towards investor education. So it's very happy to be part of this, and we are privileged as UTI to be part of your investor education initiative.
Thank you, thank you. It's so kind of you, and I have always enjoyed talking to other fund managers also before I'm talking to you, and those interviews really helped my audience to understand that how each funds are working in certain way. And when I discuss with the other fund managers, Amit sir and everyone, we were specifically Karthik sir also we have interviewed. That time we were speaking specifically to certain areas, but today we are going to cover entire
Sure.
equity scheme defined by
Sure.
SEBI. so before we starting, if you can give introduction about you, more than I said, and the same time, how did you enter into stock market? That will be a good start if I can start.
Sure. No, that is a very straightforward question, Nikhil. Like you mentioned, I have had my entire education in Delhi, and when I was doing my post-graduation, which is Masters in Finance in Delhi University, and while I was preparing for my interviews, one of the job offers that I got was from UTI. So as happens in all business schools, we had during our placement season different companies coming in, and that was the time when the tech bubble, before the tech bubble, I would say, when technology stocks were on fire, and Nasdaq had been going up for 5 years on the trot. India also in 99 had a very strong stock market. So like the scenario today, in the newspapers every day we would read about the stock markets. And when I got a job offer from UTI, I accepted it immediately because I thought this will give me a direct entry into the world of action, and hopefully I'll learn something, and in the process create wealth for investors at large. So no looking back since then. UTI has been my first job, and I've been working here for more than 24 years now.
That's it.
So yeah, that's the very, very simple, straightforward reason for me to be associated with the stock markets for so long.
Okay, that's great, and lucky also that way, because immediately you got into the job which you really love also. And
Right.
yeah, and that's great. And we are straightly, getting onto mutual fund as such. So mutual fund, we have a lot of definition. But according to you, what is mutual fund?
That's a very interesting question, Nikhil. And I would say that mutual fund is nothing but a collective investment vehicle where we pool money from small investors. And these small investors can make investments of 5,000 rupees or 50,000 rupees, sometimes even 5 lakh rupees. We pool all of this money and then invest into companies listed on the stock market. Now, what I do want to clarify here is that the investors can directly also invest into the stock markets, into the same shares they invest. The difference is the ability of an institution like UTI or any other big institution, any other big mutual fund, I would say, to differentiate itself by way of their strong research processes. So, can you make good food? The answer is yes. You can look at some cookery shows on YouTube and try to make a recipe that you like. Can you match up the expertise of a chef working in any of the big hotels in Cochin? Perhaps the answer is no. So that's the big difference. So what we are trying to do is we are trying to do two things. Number one, through distributors like you, we are trying to take this initiative of educating investors why investing and saving is important and why mutual funds should be the preferred route of investment. That's objective number one. Objective number two is when we get all of these savings, we want to use our very strong understanding of equity markets, understanding of different businesses, understanding of balance sheets of different companies and their operations to make decisions which help us in constructing a portfolio, and the endeavor finally is that this portfolio should maximize wealth for investors. So that's what a mutual fund essentially is.
Okay. So when we talk about mutual fund as a whole, because we have a thinking that mutual fund is after all mutual fund and everything is same. But under mutual fund itself, we have variety of things, right?
Yeah.
So could you just take us through that in a very quick note that why all mutual funds are not the same?
And Nikhil, by this you mean why all mutual fund schemes are not the same?
Yeah.
Is that the question?
Schemes, yeah.
Exactly. So, let me take a step back. You said that people have this feeling that mutual fund is safe. I would say yes, mutual fund is safe because it is one of those highly regulated entities by the regulator, which is Securities and Exchange Board of India, that the investors' money here is safe, which basically means that there is nothing, what should I say, untoward which can happen to the money of investors. It is managed by institutions against and following a very strong and stringent framework that the regulator has put in. So to that extent, the money is safe. Nobody is going to run away with your money. Your money is safe in the hands of any mutual fund where you invest, and the regulators are watching it very carefully. The second implication of safety could be, if I invest 10,000 rupees, would it always grow, or can it come below 10,000? Can it come to 9,000 or 9,500? The answer to that is, look, mutual funds can see volatility in terms of the principal that the investor is putting in. And therefore, your 10,000 rupees can also become 9,500 rupees, especially during phases of high market volatility. Now, if I go on to describe this element of safety, then I would say there are different kinds of mutual fund schemes. Some which are more volatile, by which I mean where your 10,000 rupees can possibly go down to even 9,000. Some which are less volatile. Usually in the stock markets, we say that larger companies which have been in business for 10, 20, 30 years and have very strong businesses, have very strong balance sheet, they are usually less volatile. Smaller companies or mid-sized companies are usually more volatile. So a very basic understanding of this subject is that if you invest into large cap schemes, the volatility is less and therefore safety is more. If you invest into small cap schemes, the volatility is high and therefore safety is lower. But I do want to clarify this. If you invest into large caps, does not mean that your 100 rupees will never come down. Even that can come down, but possibly in a smaller proportion compared to small caps. Yeah.
Okay. And when we speak about equity mutual funds as a whole, we have different types of schemes. Like you just started talking, we have mutual funds based on market capitalization or size of the companies, or we have a style, what the kind of style of companies, the nature of the company, and you pick up that kind of a universe and invest, right? So we'll get into straight that we have a large cap funds, we have a small cap, and we have mid cap. So could you take us through what is this different types of market cap and how we should see as that fund?
Sure. So Nikhil, this is in a way a continuation of your previous question. First of all, the most basic way of defining a scheme is on the basis of market capitalization, large, mid and small, as you said. Large cap companies are the top 100 companies in India as per their market cap or their market value, simply put. The top 100 companies in India as per market value are called large caps. 101 to 250th company as per the market value in descending order will be termed as mid cap companies. 251st company and beyond are small caps. Typically, we would say 251st to 500th company would be a small cap. In fact, a company even beyond 500 would also be a small cap. So that's the broad definition. Top 100, 101 to 250, 251st and beyond is the third bucket, large, mid and small. When SEBI says that a particular scheme is a large cap scheme, they basically want 80% of that scheme to invest only into large caps. That's the definition of a large cap scheme. When SEBI says that a particular scheme is mid cap, at least 65% of that scheme should be investing into mid cap securities. When SEBI says a particular scheme is small cap, again 65% at least should be invested into small cap. So this is the definition of the three schemes. In the previous question, I had told you that usually in the marketplace, large caps are less volatile, small caps are most volatile. Therefore, now that we have defined these schemes, I would like to say that large cap schemes are the least volatile schemes. Small cap schemes, as per SEBI definition, are the most volatile scheme. Do remember, as you keep increasing the time period, if you invest for 3 years, 5 years or beyond, then your ability to ultimately earn positive returns keeps increasing. The shorter the time period, the higher the risk while investing into a mutual fund scheme. If you keep expanding the time period, that risk keeps reducing of a negative return. Yeah.
Okay. So when we talk about these days returns because now if you look at it, most of the people are going behind mid cap and small cap, especially people who are buying funds. There is a tendency towards going towards the return. And what is your take on going behind return and looking at funds which are smaller companies, and there are more demand for micro cap also, because there are fund houses come up with micro cap schemes also. Definitely that comes under small cap, and there are people only investing that. They don't even touching that large cap also. So what is your take on this kind of behavior from the investors?
That's a very wrong behavior, Nikhil, and I will be extremely cautious, and I would want to advise all investors to be extremely cautious if they are investing majority of their money into micro caps, because while these kinds of companies or stocks may be doing well right now, but over a full cycle, they don't do as well, and plus they are highly volatile. When the correction sets in, the fall in such kind of stocks would be very, very high. I would say each investor needs to have a very careful allocation. For that careful allocation, they need to sit with their advisor. The role of a mutual fund advisor or a mutual fund distributor is very, very important. But at this juncture, I would just want to say that each investor needs to have a right allocation. A 80-year-old person needs to have 70 to 80% of his money into large cap schemes. Maybe nothing into small cap schemes and maybe 20% into mid caps. But I will reverse it for a 25-year-old young man who has just started his career. Maybe 30-40% of his investments can be into small caps. Maybe another 30-40% can be into mid caps. And he or she needs to have only 20% into large caps. So the right allocation and the right mix is very, very specific for each individual. It also depends on whether you would immediately need money for buying a house or sending your child for further education, in which case, your allocation to large caps should be higher again. So very specific, but yes, this behavior that we are presently seeing around investors investing heavily into micro caps and small caps is wrong behavior.
Okay.
Yeah.
So taking it this same thing, longer time, we can get a positive return. And there is a tendency that people are kind of thinking that I'm going to invest for 10 years. And what is wrong in investing in only in small cap and micro cap or avoiding large cap? And that is also a question come from our investors. So what you say that my investment horizon is pretty longer. So in that case, can I avoid large cap and concentrate only on high return schemes?
That's a beautiful question, Nikhil. I think that's what typically investors feel, that look, I'm going to hold it for 10 years and therefore I will want to maximize returns. The problem is that this 10 years comprises of phases where there can be steep corrections. And typical investor behavior for hundreds of years has been that while they feel very confident about their ability to hold on to something for 10 years and at that juncture when everything is going good, they feel that when the correction sets in, they will continue holding on. But when correction eventually sets in reality, majority people are not able to withstand the pressure and withstand the pain of correction and withstand the pain of seeing that their 100 rupees has become 60 rupees or 70 rupees. And they just wish to exit the markets at that time, or they wish to exit whatever they are holding at that time. So I would say it's very easy and theoretical to say that small caps may make higher returns over 10 years. So therefore, my horizon is 10 years. I will invest only into small caps. But people underestimate their ability or their inability to withstand the pain when the correction finally sets in. And that's why we say have a rightful exposure, so that you don't feel that pain when you are invested only into the most volatile part of the market. That's point number one. Point number two, and you may be surprised to hear this, from a return perspective, it is very surprising that over 10-year periods, small caps have given the lowest return, large caps the next, and the highest returns have been given by mid caps. So even over 10-year periods, small caps don't give returns higher than large caps. Mid caps certainly do. And the simple reason for this is mortality. Small cap businesses witness a lot of mortality. So like I mentioned, large caps are established businesses. They've been around for 30 years. And you certainly can't expect that an HDFC bank or an ICICI bank or an Infosys would go out of business because they have been able to withstand competition for many decades and have created a strong market position for themselves. That's not true for small caps. So the mortality is very high. You have businesses coming in, staying there, looking promising, but then not able to, stay for the full course. So please do remember, over long time periods in India, the maximum return has been given by mid caps, then large caps, and the lowest small caps. This is only the return. If you bring in an element of risk, which we measure by way of volatility, and without confusing your audience, we also talk about risk-adjusted return, which means if you are getting a particular return, have you made an adjustment for the risk that that particular investment has? from a risk-adjusted return basis, small caps are even worse. And large caps and mid caps are hand in hand. So that's basically it. You can never get carried away by just something which has been doing well for the last 2 years. That will be wrong behavior.
No, this is a thing which what we do look at is that go to some of the websites or any social media and we check out who's giving the best return, and we look at it 30-40% here, and there it's only 20%. Now market is in a positive note, because olden days if you say that 10% was happy.
Yeah.
But now 10% is not at all happy
Right.
thing
Right.
for the investors, especially those who are coming market now.
Right.